Hey everyone, welcome back to Corporate Decoder, the place where we turn boring paperwork into exciting stories. Today we are cracking open MFA Financial's latest filing a report so full of mortgage details it's practically a house tour on paper. Think this is just numbers? This report actually hints at shifts in the housing market, risks that keep CEOs up at night, and whether your investments are riding the next wave or about to hit a riptide. Before we dive in, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Let's take a quick look at what we're going to cover from their assets and liabilities to what they owe and own. It's like a financial autopsy, but way more useful for your investment strategy. First, let's look at their balance sheet, and this tells us what the company owns and owes. MFA Financial has a lot riding on residential whole loans, about $8.8 billion. These are basically mortgages they own, and it makes up the bulk of their assets, but pay attention to what their fair value is, about $755 billion, because that difference is important. On the other side, they owe $9.4 billion in financing agreements, so they are using a lot of borrowed money to fund those home loans. It's always a balancing act of using borrowed money to make money, but too much can be dangerous. Overall, total liabilities stand at about $9.7 billion. Now, for some good news, they have about $1.8 billion in total stockholders' equity, which is like the owner's stake in the business. Check it out for the last 3 months. Interest income from residential whole loans is $151.3 million, which is slightly down from $157 because if interest keeps decreasing, the company would need to find ways to cut costs or raise capital. This gain lands at about $54.4 million compared to a loss of about $11.5 million. This means from selling or holding loans, they are making more money now than they did, which is good. Operating and other expenses come in at $41.6 million compared to $45.3 million. Good job by the company to reduce those costs, which means increase earnings overall. So after it all, what does that make to the common guy? Basic earnings per common share was $0.32 to $0.14 last year. Always great to see that. Cash flow statements provide the real movement of cash, so let's take a quick look. Starting with a net income again of $41.20 million for the period. It's higher than $23.2 million last year. Proceeds from sales of residential whole loans are $72.3 million, which is down from $151 last year, perhaps indicating that more loans are kept and not sold compared to previous year. A final thing to note, cash paid for interest is about $122.6 million. Let's take a sneak peek at what new rules are on the horizon. There are a couple new accounting standards coming down the pike from the FASB regarding income tax disclosures and expense disaggregation. Basically, these are aimed at making companies show their financial homework in more detail, from breaking down tax strategies to categorizing where every penny goes. However, at this time, this will not have material impact on the company's financial statements. It appears the single-family transitional loan category makes up most of this company with almost $1 billion worth. So that is definitely something to keep an eye on. There have been a number of issuances of common stock too. Balance for preferred stock as of March last year is $80,000 and now $110,000 with some extra income, but some dividends declared, which brings us to the next point. For the 3-month period, their net loss on residential whole loans is $3 to $7 million as well. This is important because they have about 600 million, and that means their average return is at a rate of 1%. So the name of the game for this company is definitely volume, make a little bit of money on a lot of volume. Let's switch gears and talk about keeping the lights on. And the company has a fair bit of its own things they need to be aware about here. The company had a $128 million decrease in cash during this period. They can free up collateral to sell for money, and they can also refinance this debt, or they can just get capital from equity. All right, let's talk about risk. Here they show what would happen to their company in different interest rate environments. The first thing we can see is that with a 5-to-1 increase, it only decreases return. Finally, it should be noted that even the CEO and CFO found no meaningful issues, which is not a guarantee for smooth sailing, but certainly a great sign. Now, what's the big picture here? It seems as if MFA has the experience and means to handle and navigate the mortgage ecosystem. Their returns might be lower and their actions might not be flashy, but they are definitely here to stay. However, the housing environment is looking rocky, and there are a few things to pay attention to their higher debt level due to interest rates. So in my opinion, these actions would help the company do well in the long run. The focus would be safety. All right, that's our breakdown of MFA Financial's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.